You already know the Strait of Hormuz is closed. You've read the headlines. You've seen the oil price charts. So I'm not going to tell you what happened. I'm going to tell you something the news missed. The Strait of Hormuz was not closed by missiles. It was not closed by a naval blockade. It was not closed by any government decree. It was closed by 7 insurance companies filing paperwork. Between the 1st and 2nd of March 2026, 7 of the 12 clubs that insure 90% of the world's ocean-going ships issued 72-hour cancellation notices. Not warnings. Not premium increases. Cancellations. And the moment those notices landed, the economics of crossing the strait became impossible. Not dangerous. Impossible. Because here is the thing about global shipping that almost nobody outside the industry understands. A ship cannot sail without insurance. Port authorities require it. Banks financing the cargo require it. The charterers require it. Remove the insurance, and the ship does not move, even if the water is physically open. That is the real story of the Hormuz closure. And it changes everything about when, and how, it reopens. I'm Arman Akbary Khan. This is the Trifecta. Let's go deeper. War risk insurance is not like car insurance. It is a specialized global market, mostly centered in London, governed by a committee called the Joint War Committee, part of the Lloyd's of London market. This committee maintains a list of geographic areas where the risk of war, terrorism, or piracy is deemed elevated. When a region gets added to that list, ship owners cannot simply sail through it on their existing policy. They have to pay what is called an additional premium, a separate charge per voyage, just for entering that zone. Before February 28, 2026, the additional premium for transiting the Strait of Hormuz was 0.25% of the vessel's hull value. For a typical large oil tanker worth $150 million, that meant about $375,000 extra per voyage. High, but manageable. Ships were still moving. Within 48 hours of the war starting, that number jumped to 1%. Same ship, same voyage, same waterway. Now the insurance alone costs $1.5 million for a single crossing. And then the P&I clubs canceled entirely. P&I stands for Protection and Indemnity. These are the mutual insurers that cover third-party liabilities, crew injuries, pollution, damage to other vessels. All 12 clubs in the international group gave 72-hour notice that their war coverage in the Gulf was void. Effective midnight, March the 5th. At that moment, the transit cost went from expensive to economically impossible. Because without P&I cover, you cannot charter the ship. You cannot finance the cargo. You cannot dock at the receiving port. The paperwork chain collapsed, and the ship stopped. Not because of a single missile. Because of the actuarial logic of 7 mutual insurance clubs simultaneously deciding the risk was unwritable. Here is something that did not make any headline. The Hormuz crisis did not hit a healthy insurance system. It hit a system that had already been bleeding for 26 months. Remember the Red Sea? The Houthi attacks on shipping that started in late 2023? Those attacks drove war risk premiums for the Bab el-Mandab Strait from 0.05% to 1% of hull value, a 20-fold increase, within 3 months. Transit volumes through the southern Red Sea collapsed 65%. Fewer ships transiting meant fewer premiums flowing into the war risk pool. But the claims kept coming. By February 2026, the week before the Iran strikes, the capital buffer supporting global marine war risk underwriting was at its thinnest point in the modern era. The war risk system had been running a slow hemorrhage for over 2 years. And then Hormuz hit. This matters because it tells you something about the timeline for recovery. The system does not reset the moment a ceasefire is announced. The capital has to be rebuilt. The reinsurers have to return. The risk appetite has to recover. Even if the shooting stopped tomorrow, the insurance market would need weeks, possibly months, to normalize. The military conflict and the financial conflict are 2 separate timelines, and the financial one moves slower. While the big tankers waited at anchor, something else was happening. The ships that could still move, the ones outside the exclusion zone, became extraordinarily valuable. Daily charter rates for oil supertankers quadrupled within 1 week. Before the war, around $200,000 a day to charter a very large crude carrier. By March the 7th, nearly $800,000 a day. One ship, one day. $800,000. And the oil still has to move. Refineries don't stop. Power plants don't pause. So buyers, refineries in Asia, energy companies in Europe, are paying that rate. And they are passing it forward, into the price of fuel, into the price of electricity, into the price of everything that moves or is made using energy. That $800,000 day rate is not visible on any consumer's bill. But it is in there, hidden inside every price increase you have seen this month. There is also something happening at a government level that is not getting enough attention. The U.S. government announced a $20 billion reinsurance backstop, partnering with insurer Chubb, specifically designed to revive shipping through the strait. The UK Chancellor flew to Lloyd's to discuss the same thing. These are governments trying to replace the commercial insurance market with sovereign guarantees. And here is the problem. Moody's reviewed the U.S. plan and concluded it is unlikely to resolve the blockade, because it covers political risk and cargo loss. It does not cover crew liability. And no captain sends their crew into an active war zone based on a financial guarantee from a development finance agency. The ships are not waiting for better insurance terms. They are waiting for safety. Those are two completely different problems. If you want to know when this is actually resolving, ignore the diplomatic statements. Ignore the ceasefire rumors. Ignore the oil price. Watch one number. 70. 70 vessels per day through the Strait of Hormuz is the threshold that shipping analysts have identified as the signal that the actuarial blockade is breaking. Before the war, the 7-day average was approximately 77 crossings per day. On March the 3rd, 5 days into the conflict, only 4 vessels crossed. By March the 16th, it was 2 crossings, in a waterway that was built to handle 77. If that number recovers above 70 within 14 days of March the 5th, the day the P&I clubs went void, the financial blockade is unwinding and the system is healing. If it does not, the blockade is structural, not temporary, and the energy market will need to reprice for a prolonged disruption. You can track this yourself. The data comes from Windward Maritime AI, Vortexa Satellite Tracking, and Lloyd's List. All published daily transit data. 70 is the line. Watch it. Let me be specific about what to do with all of this. Move 1. Stop pricing this as a spike. Start pricing it as a floor. Every energy cost assumption in your business that was set before February 2026 is wrong. Not temporarily wrong. Structurally wrong. The insurance system needs months to recover even after the shooting stops. The tankers sitting at anchor are not going to sail the moment a ceasefire is announced. Model your costs at current energy prices for a minimum of 6 months. Then build a scenario at 12. Not because you are predicting the future. Because the cost of being wrong on the downside is higher than the cost of planning conservatively. Move 2. Add a war risk clause to any logistics or supply contract you sign in the next 90 days. The phrase you want is energy cost escalation clause with a war risk trigger. It allows you to renegotiate pricing if energy or shipping costs move beyond a defined threshold due to an active conflict designation. The insurance industry has been writing these into contracts for decades. Your contracts should have them now too. Move 3. The clean energy transition just received its single most powerful political argument in history. Not climate, security. Every government that just watched its energy supply held hostage by a war in a waterway they do not control is now having an emergency meeting about domestic energy production. Solar, wind, battery storage, small modular reactors. All of these are about to receive policy urgency and capital flows that dwarf anything the climate agenda ever generated. If you are allocating capital or making career decisions, follow that signal. It will be one of the defining investment themes of the next decade. Before we move to the next episode, 2 AI prompts worth running right now. Both work on Claude at claude.ai or Gemini at gemini.google.com. Both are free. Pause here. Copy the one that fits your situation. Run it. Drop your sector and your key finding in the comments. I read every one. Here is where we are. Episode 4 looked at Bangladesh, the most exposed economy in the world to this exact combination of pressures, and showed you what global disruption looks like at street level. This episode went one layer deeper, into the mechanism nobody is explaining. The reason the strait closed is not the one on the news. It is a paperwork problem, and that makes it more persistent, not less. But there is still a layer above all of this that we have not touched yet. Why did the United States and Israel make this decision? Not the military rationale, the political one. Why did Washington act without NATO, without the UN, against the explicit position of most European governments? And what does that decision tell us about how the world is actually being run right now, and who gets to set the rules? That is Episode 6, The Geopolitics, the Fracture of the Western Alliance. Not as a theory, as a documented, ongoing reality with named actors and specific decisions. It will change how you read every international news story for the rest of the year. If this episode gave you something the news didn't, share it with one person who would use it. And if your organization needs frameworks to operate in exactly this environment, Stop Guessing Store has the toolkit named Crisis Operation Playbook. Link to the store is in the description. Stay sharp, stay adaptable, and stop guessing.